Welcome to the September 22nd, 2025 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. Big questions this week. What did the Federal Reserve say? What are the dangers unfolding? And how do we avoid those dangers? So we're going to walk you through that with some precision. All three major indexes powered to all-time new highs this week. The Dow's now up 10% for the year, and we have the NASDAQ curiously up 17% for the year. It is a technology frenzy, and the dangers are already becoming apparent as we go into this from those of us who successfully managed portfolios through the tech wreck and recovered rather rapidly, even from the 2008 crisis. I'm seeing some warning signs, and I'm going to cover them here so that you can be aware of what's actually happening. All right. The first warning sign that we see now that the Fed has cut rates. Well, let's look at those rates. That we told you the T-bill last week before the Fed meeting hit 3.9%. It signaled a 0.3% cut, which is rare because they don't really do that. Now, you got 4.125 as the intended Fed funds target, the midpoint from 4.25 to 4. After the 0.25% cut, finally the stubborn Fed cut rates, and Jerome Powell, who Trump called Mr. Too Late, a fool, a total loser, a stupid person, finally he cut rates. Now, notice the Treasury rates moved down ahead of this. The Fed is leaky. All the suits get together during the day, and then sometimes they play golf and they talk a lot, the bankers and the Fed, and it leaked out. You can see the information leaking out somewhere maybe 3-4 weeks ago. But there's something important here. The 10-year Treasury drives the mortgage rates. It's usually 10-year Treasury plus 2% adjusted for credit quality. Mortgage rates are actually down from the end of May. You're down 0.5%. That's good news for the economy. Evidence that Jerome Powell is Mr. Too Late. Well, building permits for new houses down 11% over last year. So they waited as long as they could, and now they've signaled a cut. Why did the T-bills move down ahead of the Fed? You wouldn't accept 3.9 if the resulting rate was going to be 4.125. They said they are likely to cut rates October 29th and December 10th, lowering borrowing costs. Auto loans already down, mortgages already down. That's good for the economy. Economy came in at 3.3% growth in the third quarter, very healthy according to the Atlanta Fed. That's good news. Retail sales up 5% over last year and up an accelerated 0.6% just for the month in August. So things are fine. Why would I talk about the Treasury market? Something happened. You can go to usdebtclock.org. This is the biggest change in the perception of U.S. credit quality in decades, I believe. The federal budget deficit. It was $2.1 trillion and growing just a few months ago. $1.9 trillion in the deficit and falling. You don't have to eliminate the debt to prove that the U.S. Treasury is likely the most worthy bond in the whole universe. It sets the stage potentially for extremely low rates on U.S. Treasuries. Good news for the budget deficit too. So that's begun to accelerate down. DOJ says they've identified $639 billion in savings. It's moving in the right direction, diffusing that debt bomb if you were worried about that. What's this? Oracle. Whoa. Becoming one of the top 5 most valuable companies in the world, right? And this was Austin, Texas-based Oracle spiking on the news that they have hundreds of billions of dollars worth of contracts for their work on data centers. This is a huge capital expenditure build out that is going on right now, and everybody's excited about it, from the nuclear to the different companies. But here's your danger. CoreWeave. This company has never made money. They are worth $60 billion, and they're losing money. They are trading at $60 billion, 12 times their $5 billion in sales. They happen to have nearly $20 billion in debt, and they're one of the big data center beneficiaries of the AI boom. You measure the danger of a company by the ratio of profit to debt. Well, they don't have any profit. Or you could do revenue to debt. Their debt is at least 3 times, if not 4 times, their revenue. And they're paying 9% on that debt and losing money and valued at $60 billion. Does that seem dangerous? You bet it seems dangerous. And that's in a lot of the indexes. So if we go back and look at some of the mistakes people made, this is the United States Natural Gas Fund. Big mistakes in ETFs. All the bearish ETFs, lots of them just went away. So you have to be very careful. This has nothing to do with the price of natural gas, but that was its intention. What is it? It's a derivative ETF, exchange traded fund. Those are big dangers as well. If they say 2 times the NASDAQ or 3 times the NASDAQ, that's a derivative fund, and that could be very dangerous as well. All right, growth and innovation has a place. I'm not saying don't do tech. I'm saying be careful and harvest into tactical safety, high cash flow global lending. I'll tell you, with the Fed cuts, the net present value of future cash flow for a basket of loans and bonds, like be the bank, that has a higher present value as a result, and we'll see it. Growth with income. Now that the interest rates on the Fed funds rates 4.25, anything with a rising dividend that pays close to that is a much better inflation hedge, and we will get to the energy revolution and specifically natural gas in a special episode here on YouTube. That's why you want to subscribe. I'm Spencer McGowan, your financial weatherman and President, McGowanGroup Wealth Management. We serve affluent families right here from the Crescent. We love smart, happy, wealthy people, and that's the way the team is building too. We like team members that are dedicated to your success. That's why we're the team that cares. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.